So hello everyone again, and the last place we left off was on slide 44. Now this is the next big topic in chapter 10, and this is called internal rate of return. It's 5:27 in the morning, so if you don't mind, I have to sip my coffee. So this topic is associated with net present value and what internal rate of return is telling you. And it says it very succinctly right here. The discount rate that equates the net present value of an investment opportunity with $0, because the present value of cash inflows equals the initial investment. So this is the point where the cash that comes in is equal to the amount of money you invested, okay? It's the break-even point. So it's the rate of return that the firm will earn if it invests in the project and receives the given cash flow. So that's what this all is, okay? And this is an important statement, okay? So actually, here's a simple equation. All they do is take the equation I showed you for net present value, and they just set it equal to 0. Now, this is difficult to solve by hand. You really need to use the Microsoft Excel for this, okay? Really, that's the only easy way to do it. So basically, there's another way to define it here. Recognizing that projects may have cash inflows or outflows in any time period, including period 0, we can define the internal rate of return more generally as this way, okay? So what they do is they take the CFO and they just wrapped it up and change this T equal 1 here, see that? To T equals 0. And they just wrapped this up into there, okay? All right, so this is a more general form of 10.3. So this is an important topic, and so here's the most important decision criteria. The way we had a decision criteria for net present value, we have a decision criteria for internal rate of return, and here it goes this way. If the internal rate of return is greater than the cost of capital, accept the project. If the internal rate of return is less than the cost of capital, we reject the project. Now we're going to find out, I'm going to actually give you extra material. You're going to find out that the internal rate of return has a lot of pitfalls to it, okay? Most people use the net present value because it's straightforward and there's not as many pitfalls. But the internal rate of return is filled with a lot of pitfalls. And I'm going to try to show you some of them in upcoming videos. All right, so you can use the, it's not easy to do, like I said, the internal rate of return by hand. So you can either use a financial calculator or the built-in function in Excel. The built-in function in Excel is got a function called IRR. And I don't know if I have Excel up here. But let me see if I can, I tell you what, let me see if I can bring up the Excel function. Give me 1 second. All right, so anyway, I brought up the Microsoft Excel function. I want to show you where internal rate of return is. See right here? There's built-in finance functions. If you click on that, you can see a pop-up box comes up. And if I type IRR, because I know it is, and I say go, you can see IRR pops up here. And you see what it says, returns the internal rate of return for a series of cash flows, okay? So if I click on that, all you got to do is put the cash flows in here. It's you could put the cell numbers too, a series of cell numbers. So you would really use this for Microsoft Excel. Use this for internal rate of return. It's much easier than doing a calculation. All right, I just wanted you to see that. So getting back to the slides. So here's an example of calculating internal rate of return the long way by hand, which becomes, it's too difficult to do this, obviously. You'd have to get this, trial and error here. And you can see they kind of say that, is you have to use a trial and error approach. But realistically, you take these numbers here and you just pop these into Excel. Okay, into the IRR function in Microsoft Excel, just the way you see them. All right, so here's the calculator. If you have one, you can try it with that. All right, so if we pop them into Microsoft Excel, the IRR function, and they do the calculation from the previous example for Bennett Company, you can clearly see here that the internal rate of return is much greater. In both cases, for both projects, it was much greater than the cost of capital. Right, here's the internal rate of return, here's the cost of capital. So you would basically, it's telling you the same thing that net present value that it said do the projects, okay? So it's telling you to do these projects. However, this one is telling you this one's more worth doing. And according to internal rate of return, you would want to do B, right? Because B provides a higher return here. So you can kind of see here, comparing the two projects, IRRs, internal rates of return. Bennett, its managers rank Project B over Project A because Project B delivers a higher internal rate of return. If these projects are mutually exclusive, meaning that Bennett can choose the one project or the other, and they had to pick one, you would take Project B, all right? That's if they were mutually exclusive. So that's the way that all goes. All right. So here's the most important thing, right? And again, as I talked about the Microsoft Excel. So here's the spreadsheet example. And I think you should really follow this very, very carefully, all right? I think you should follow this very carefully. And I would basically really practice with this because it's handy to have. So here's your initial cash flow. So here's the cash flows. And the internal rate of return function is gonna give you the value right here. You see that, right? So what you had to do is enter the cash flows, or even the cell numbers where the cash flows are in, and you get these values. Here's Project B. Here's Project A. Okay, and it's that simple. It's just that simple. So here's the way it looks on a timeline, all right? Again, this was the timeline. Okay, here's the internal rate of return that we for Project A. We previously saw these timelines, right? And here's Project B. And you can see it's the point where at this point and at that point, both of these projects, the net present value becomes 0 here. So, so this is the whole items behind net present value. So here's an example of Tony DiLorenzo, and he's got a couple. He's got a couple business opportunities, and his cost of capital is 9%. So his initial investment would be $7,500, so that would be negative, and then he'd have a bunch of cash flows. Right, and he'd have a bunch of cash flows. So Tony DiLorenzo's cash flows look something like this. Tony summarizes the after-tax cash flows. Here's the initial investment. You notice it's negative, right? And then here's the cash flows, right? And then he gets a big one at the end here. So substituting the after-tax cash flows for years 0 through 8 into a financial calculator or spreadsheet. And you should try this. He finds the internal rate of return is 9.4. Given that the projected internal rate of return of 9.4 exceeds Tony's required minimum return of 9, the investment is acceptable. All right, so I'm 11 minutes into this one. I will pick this up here on the next part, this slide, all right, because this is a little complicated.